Most traders are unknowingly sitting on a ticking time bomb, confusing the easy gains of a decade-long bull market with actual skill. It's a terrifying reality to realize that those years of hard-earned savings can vanish in just 6 months when a bear market arrives, leaving you trapped in a decade-long wait just to break even. While most people search for answers in the noise of financial news or biased advisors, they find only more uncertainty and emotional chaos. This book reveals a better way through a quantified rate map of 7 non-correlated systems that have historically delivered a 30% CAGR while remaining virtually immune to market crashes. By automating your strategy based on price action instead of guesswork, you can finally reclaim your time and achieve true peace of mind, regardless of what the economy does next.
Yeah, I mean, that is just the incredibly high-stakes reality we're going to unpack today for you. The source material we are diving into is Automated Stock Trading Systems by Lawrence Benstorp.
Right, and it's a deep one.
It really is. And, our mission in this deep dive is to fundamentally rewire how you view, measure, and just generally interact with stock market risk. We aren't just going to talk about abstract theories here.
No, we really want to get into the weeds today.
Exactly. We're going to look under the hood at the exact mathematical mechanics of building this all-weather, completely emotionless wealth-building engine.
Because honestly, investing without a quantified, rigorously tested system is basically what the vast majority of retail investors do, right? Even professional fund managers.
Oh, absolutely. Most of them.
And it's like trying to sail across the middle of the Pacific Ocean in a wooden rowboat. I mean, you are completely exposed to the elements. You're constantly bailing water, watching the clouds with dread, just, sweating out every single wave and praying the weather holds.
Yeah, you're just at the mercy of the ocean at that point.
Right. If a macroeconomic storm hits, you have no defense. But what this source material teaches you is how to build a nuclear submarine instead. Once you're sealed inside that submarine, the weather on the surface simply no longer matters.
I love that analogy. It's so accurate.
Yeah, like a Category 5 hurricane could be raging up above, ripping all those little rowboats to shreds, but down below, you're operating entirely on instruments, just mathematics and pressure gauges. You are completely insulated from the surface chaos.
That is a phenomenal way to visualize it. But before we can start welding the titanium hull of this submarine, we have to completely deconstruct the myths that the traditional financial industry has sold to you for decades. We have to clear the shipyard, so to speak.
That makes sense. We have to tear down the bad ideas first, which brings us right into lesson 1, the illusion of skill.
Yeah, this is a big one.
It really is. This concept of recency bias is a massive psychological trap. I mean, you have traders who rode the historic bull market from 2009 right up to the end of the 2010s, and they genuinely believe their portfolio grew because they're like financial savants.
Right, they think they're geniuses.
Exactly. They attribute their success entirely to their own intellect rather than acknowledging they just had a massive historic macroeconomic tailwind pushing them forward.
What's fascinating here is how quickly human neurology adapts to positive outcomes. Right? We just naturally claim them as a reflection of our personal skill.
Oh, for sure. It's human nature.
But if you throw a dart blindfolded at a board full of tech stocks during a decade-long quantitative easing bull run, chances are you're going to make money. The rising tide lifts all boats.
But the historical reality checks in this book are just sobering.
Extremely sobering. We have to look at the visceral reality of what a market crash actually feels like. Take the 2008 financial crisis following the Lehman Brothers collapse. We aren't just talking about a bad week here.
No, it was a bloodbath.
The S&P 500 index dropped an astounding 56%.
Let me just pause there, because I feel like that's a massive claim that people gloss over as just a number on a page. 56%. If you had $1 million saved for your retirement, you woke up and had $440,000.
Precisely.
Yeah.
Just imagine the physical nausea of logging into your Vanguard or Fidelity account and seeing hundreds of thousands of dollars just gone.
I'd probably throw up, honestly.
Anyone would. The trading floors in Chicago and New York were dead silent during that time. People were literally paralyzed. And here's the truly devastating part.
What's that?
If you follow the traditional advice to just, hold on, you rode that elevator all the way down. And if you rode it all the way back up, you didn't break even until 2013.
Wow.
Yeah, that is 5.5 years of your financial life completely frozen, just to get back to zero.
And 2008 isn't even the most extreme example in the data. Look at the 2000 dot-com bubble burst. That was a 49% drop. But it took over 7 years, 86 agonizing months, just to recover your principal.
It's a massive chunk of your working life.
Right. And if we look at the mother of all crashes, the 1929 Great Depression, the market suffered an 87% drop. It took 25 years just to get back to the previous high. A quarter of a century.
Yeah, nobody has the lifespan to just ride out a 25-year drawdown. They absolutely do not.
Nobody.
And this gets to the core mechanism of what drives human failure in the markets. It's the psychology of maximum pain. You see, when a portfolio drops 10%, a trader might feel a little nervous, but they brush it off.
Sure, 10% is normal volatility.
Exactly. But when it bleeds into a 20% loss, they start, frantically reading financial blogs looking for reassurance. When it hits 30% and then 40%, rationality completely evaporates.
Because every single day, you're watching your life savings evaporate.
Yeah. And the news is screaming about the end of the financial system. There comes a breaking point where the psychological torment of hoping for a recovery just becomes too much to bear.
So what happens to those buy and hold investors then?
Traders who swore up and down that they were strictly buy and hold end up capitulating. They sell everything at the absolute bottom.
But why do they do that? I mean, if they held on for a 40% loss, why sell at the very bottom?
Just to stop the emotional bleeding. It is a biological flinch response. They sell out of pure panic, cementing their losses permanently, usually right before the market eventually turns back around.
But wait, I really have to push back here on behalf of everyone who has ever had a 401k meeting with a financial advisor. Isn't the entire mantra of traditional, respectable investing to just ride it out?
That is what we're all taught, yes.
You're explicitly told that the stock market always goes up over a long enough timeline. So if that's true, why is holding on through a crash considered such a catastrophic, system-breaking mistake?
Well, if we connect this to the bigger picture, relying on the market to eventually recover robs you of the single most valuable asset you have in wealth building, time. It comes down to the brutal mathematics of compounding loss. Let's keep the math incredibly simple for a second. Say you have a $100,000 account. The market crashes and you suffer a 50% drawdown.
Okay, so my account is now at $50,000.
Right. To get back to where you started, just to break even at 100 grand, you do not need a 50% gain. You need a 100% gain on that remaining $50,000.
Ah, I see. Because the pile of money you are earning interest on is now half the size.
Exactly. You have to double your money just to get back to zero. A decade lost to breaking even is a decade of lost compound interest. It completely derails retirement plans.
I mean, it literally forces people to work an extra 7 or 8 years longer than they intended.
Exactly. You simply cannot afford to lose the time it takes to recover from a 50% drawdown.
Okay, that makes perfect sense. So if relying on a general market upswing is an illusion of skill, and writing it out is a mathematical trap that steals a decade of your compounding time, then the very yardstick we use to measure financial success might be completely flawed.
It absolutely is.
Which brings us to the next point. Lesson 2, the benchmark trap. If I turn on any financial network, the S&P 500 is treated like the absolute gold standard.
It is the default benchmark. The S&P 500, which is often represented by the ETF ticker SPY, is basically a basket of the 500 largest publicly traded companies in the United States.
And the industry treats beating the SPY as the ultimate goal.
They do. But let's look at the actual historical performance from January 1995 to July 2019. Over that multi-decade period, the SPY delivered an 8.02% compound annual growth rate, or CGR.
CAGR.
Yeah, CGR is just a smoothed-out average of how much your money grows each year over a specific period, assuming you reinvest the profits.
Okay, so 8% a year sounds pretty decent to the average person, honestly.
It does, until you look at the cost of that return. To get that 8% CAGR, the SPY forced investors to endure that devastating 56.47% maximum drawdown we just talked about during the 2008 crash.
Right, and drawdown simply means the percentage drop from the highest peak your account ever reached down to its lowest valley before it recovers.
Exactly.
Okay, let's unpack this with an analogy. Judging your entire financial security solely by whether you are beating the S&P 500 is like bragging that your side of the sinking ship is going underwater 10 minutes slower than the other side.
That's hilarious, but it's true. You're still drowning.
And this applies even to the absolute titans of the industry. The data looks at Warren Buffett and Berkshire Hathaway. His buy and hold fundamental value approach is legendary.
The most famous in the world.
Right. But over a similar period, from 1996 to 2019, his approach yielded a 9.87% CAGR. He beat the SPY's 8%, yes, but he still suffered a massive 54.57% drawdown.
Yeah, even the greatest fundamental investor in human history lost more than half his portfolio's value during a market panic.
Which is why measuring success purely by return percentage is just dangerous.
What's fascinating here is the introduction of a far superior metric for measuring the true health of a trading system. It's called the MA ratio.
MA ratio, what does that stand for?
MAR stands for Return over Maximum Drawdown. You calculate it by taking your compound annual growth rate and simply dividing it by your maximum drawdown. It is a pure measure of risk-adjusted return.
Okay, so let's do that math. For the S&P 500, an 8.02% return divided by a roughly 56.5% drawdown gives you a MAR ratio of 0.14.
Exactly. A MAR ratio of 0.14 is absolutely abysmal. Warren Buffett's MAR over that period was 0.18.
Wow, that really puts it in perspective.
The core thesis of this deep dive is that a wealth-building system is only truly robust and only truly valuable if it provides high returns without destroying your underlying capital and your psychological well-being in the process.
Right. You want a MAR ratio that is significantly higher than 0.14. You want a system that gives you the returns without the sleepless nights.
Exactly.
So if we can't rely on the traditional benchmark because it exposes us to these wealth-destroying 50% losses, and we absolutely know from the historical data that massive market crashes are inevitable, how do we actually decouple our money from the S&P 500's gravity?
That's the million-dollar question.
How do we stop our portfolio from plummeting into the abyss when the broader index plummets? That leads us straight to the core engine room of our submarine. Lesson 3. The magic of non-correlation.
This is where it gets really fun.
So in theory, the idea of having multiple investments that don't move in the same direction sounds great. It's the old don't put all your eggs in one basket adage. But does the author actually prove this works with real back-tested historical data?
He absolutely does. And the data is just staggering. The central thesis is elegantly simple in theory, but profound in its mathematical application.
Okay, lay it on me.
By trading multiple non-correlated systems simultaneously, you statistically lower your overall risk while exponentially increasing your returns.
And non-correlated simply means that the underlying algorithms driving the trades do not trigger at the same time or react to the same market conditions, right?
Precisely. When one system is losing money, another entirely independent system might be making a fortune or just staying completely flat in cash.
And the numbers back this up. The material outlines a combined 7-system approach. From 1995 to 2019, this combined approach generated over a 30.4% CAGR.
Which is astronomically higher than the S&P 500's 8%.
Right. But the most important part, it achieved that 30% annual growth with only an 11.83% maximum drawdown.
Let's calculate the MAR ratio on that.
Yeah.
A 30.44% return divided by an 11.83% max drawdown gives you a MAR ratio of 2.57.
Whoa!
Yeah, compare that 2.57 to the S&P's 0.14. That is an absolute paradigm shift in how money is managed.
I want to look under the hood of that idea for a second. How does that math actually work in practice? How do you get massive returns with almost zero major drawdowns?
It comes down to a concept called smoothing the equity curve. Imagine you have a long-term trend system that is designed purely to capture big bull markets. It buys stocks that are going up and holds them.
Okay.
In a bear market crash, that system is going to automatically trigger its stop losses, its emergency exits, and go to cash. Maybe that specific system loses 10 or 15% before it shuts itself off.
Makes sense.
But simultaneously, in another engine room of your submarine, you are running a short-selling system. This system is mathematically designed to profit when stocks drop rapidly.
Oh, I see where this is going.
While your long system is drawing down 15%, your short system is aggressively executing trades and might be up 25%.
So the net result, your total portfolio is actually up 10% during a market crash.
Exactly. You never dig a hole you have to fight your way out of.
Here's where it gets really interesting, and I have to ask this because it's what immediately pops into my head. Doesn't cutting your downside risk automatically handicap your upside potential?
Yeah, it's a very common question.
Like, if I have one system actively betting on the market going up and another system actively betting on the market going down, won't they just cancel each other out? Won't that short system just bleed money and drag down my profits during a roaring 10-year bull market?
Is a brilliant question, and it's the exact hurdle that trips up traditional fundamental investors. But here's the magic of how these algorithms are designed.
Okay, I'm listening.
Because these different systems have very specific, mathematically rigid triggers for entering and exiting trades, they do not simply cancel each other out perfectly like a zero-sum game of tug-of-war.
Right.
Instead, they're hunting for specific, distinct statistical edges that only appear at certain times. For example, a short-selling system isn't just blindly shorting the entire S&P 500 forever.
So what is it doing?
It is patiently waiting for highly specific conditions. Maybe a stock that has unsustainably spiked 40% in 3 days due to irrational greed. It grabs a quick profit on the inevitable pullback and gets out.
Ah, so it's surgical.
Exactly. So, yes, a short system might have a tiny bit of drag during a massive multi-year bull run, but the reduction in overall portfolio volatility is the secret weapon here.
Because your total account never takes a 50% hit, you avoid the math of having to double your money just to break even.
Precisely. The smooth, uninterrupted compounding of your capital mathematically overtakes the volatile start-and-stop approach of a single system.
Okay, so to capture all these different edges, bull markets, bear markets, sideways chop, you clearly need distinctly different engines running inside your portfolio submarine. You can't just have 7 engines that all do the exact same thing, right? That's just correlation in disguise.
Correct. You need diversity in your algorithms.
So what exactly are these engines? Let's break down the mechanics in Lesson 4, Master the 4 Pillars.
Okay, let's dive into it.
If we know we need these non-correlated engines running simultaneously, so one zigs while the other zags, what exactly do those engines look like mathematically?
The source material outlines 4 highly distinct trading styles that form the foundation of this multi-system approach. Let's walk through the mechanics of each one.
Sounds good.
Pillar 1 is long-term trend following long. This is the classic strategy of riding upward momentum. Mechanically, an algorithm might look for a stock whose 50-day moving average just crossed above its 200-day moving average.
What does that actually tell the algorithm?
It tells the computer, objectively, that institutional money is pouring into this stock and creating a massive, sustained uptrend. The computer buys the stock, and its only job is to use a trailing stop loss to stay in that trade for as long as the trend continues, whether that's 3 months or 3 years.
Got it. Riding the institutional wave. What's the second?
Pillar 2 is mean reversion long. This is entirely different. This is buying short-term irrational fear.
Okay, interesting.
Mechanically, the system might use an indicator like the RSI, the Relative Strength Index. If a stock's RSI plummets below 20, the mathematical reality is that the stock is severely oversold. Panic has set in.
Let me jump in with an analogy here because I think it helps visualize what mean reversion actually is. It's not magic. It's like a rubber band that has been stretched way too far downward by pure panic.
That's a great way to think about it.
But why does the rubber band snap back? It's not just a rule of the universe, it's market mechanics. When retail investors panic and dump millions of shares of a perfectly good company, market makers, the big institutional computers providing liquidity, are forced to absorb that selling pressure.
Right, they have to take the other side of the trade.
Once the panic exhausts itself and the selling starts, those market makers have to rapidly adjust their inventory, aggressively buying the stock back up to balance their books. That massive institutional buyback is what snaps the rubber band back to its historical average, or its mean.
That is an incredibly accurate description of the underlying market plumbing. Mean reversion long algorithms simply identify that stretched rubber band and buy the dip, knowing the mechanical snapback is statistically imminent.
Okay, what about Pillar 3?
Pillar 3 is the exact opposite side of that coin. Mean reversion short. You are selling short-term greed.
So the rubber band's stretching up.
Exactly. You find a stock where the RSI is spiked above 85, what the author calls stupid money flooding in and driving the price unsustainably high in a matter of days. The upward rubber band is stretched to the breaking point. You short it, expecting it to rapidly fall back to its mean once the euphoria burns off.
And Pillar 4.
Pillar 4 is long-term trend following short. This is the mirror image of Pillar 1, designed to profit from prolonged downward trends in the broader market like we saw in 2008 or the 2022 tech sell-off.
What's absolutely crucial for you, the listener, to understand here is that trend following and mean reversion fundamentally rely on completely opposite conceptual beliefs about how the market is acting in that specific moment.
That's exactly right.
In mean reversion, you are betting the rubber band snaps back to normal. In trend following, you are betting that the rubber band actually breaks and a completely new reality sets in. The stock price isn't going back to its old normal, it is establishing a new paradigm.
Exactly. And because they rely on opposite psychological states and market conditions, they naturally do not correlate.
Which is the whole point.
Right. A trend-following system will suffer horribly in a choppy, sideways market. It will buy a breakout, the breakout will fail, and it will lose a little money. It will do that repeatedly. That's called getting whipsawed.
Sounds painful.
It is. But a sideways, choppy market is exactly the environment where a mean reversion system thrives. It loves bouncing back and forth within a channel, collecting profits off the overreactions on both ends. They protect each other.
So having these four pillars, these four distinct engine rooms is fantastic. But building the engines is only half the battle of building our submarine. How do you decide how much fuel to pump into each engine at any given time?
Yes, the calibration.
How do you balance the ballast tanks so the sub doesn't just flip over? If you put 90% of your money into a highly volatile mean reversion short system, you could blow up your entire account in a week.
Oh, easily.
Yeah.
Without a doubt.
This is a topic I feel like nobody in the mainstream financial media ever talks about, but the author stresses it as the absolute key to survival. Which brings us to lesson 5. Position sizing is your only real lever.
It is arguably the most important mechanical lesson in the entire deep dive. The author makes a profound, indisputable point. You could take two traders, give them the exact same algorithmic system, with the exact same buy and sell rules, trading the exact same stocks on the exact same days, and they can have wildly different outcomes.
Meaning one gets rich and one goes broke.
Yes. One trader gets fabulously wealthy and the other goes completely bankrupt. Why? Based entirely on their position sizing. Position sizing is the only dial you actually control to manage risk and engineer your specific financial objectives.
The material details a specific combination of two rules to manage these ballast tanks: percent risk and percent size. And it strongly advocates capping any single system at a maximum of 10 positions at one time.
Yeah, that cap is vital.
If the algorithm scans the market and finds 50 different stocks that meet the buy criteria on a single Tuesday, you don't buy all 50. You mathematically rank them and buy only the top 10. This prevents you from accidentally over-leveraging your entire account just because the broader market had a wildly volatile day.
If we connect this to the bigger picture, the goal of position sizing is to mathematically equalize the risk across completely different types of assets.
How do you do that?
You do this by calculating the specific volatility of a stock using a metric called the average true range, or ATR.
ATR, let's dig into that.
ATR simply measures how much a stock's price moves up or down on an average day over a recent period. Let's say you have a boring, highly stable utility stock. It barely moves $1 a day from its open to its close. Its ATR is $1.
Okay, pretty sleepy stock.
Then you have a wild, headline-driven biotech stock that routinely swings $5 a day. Its ATR is $5. If you just blindly take $10,000 and buy shares of the utility stock and another $10,000 to buy shares of the biotech stock, you've created a massive imbalance in your submarine.
Because if the overall market drops, that wild biotech stock is going to gap down and do significantly more structural damage to your portfolio than the utility stock.
Exactly. By incorporating ATR, the math dictates that you buy far more shares of the stable stock and significantly fewer shares of the wild stock. This ensures that the actual dollar amount risk to your total account remains identical for both positions.
Okay, let's slow this down in ELI 5. I'm 5. What does this all mean for the listener sitting at their kitchen table with a calculator? Let's walk through a highly specific math example from the material step by step.
Sure, let's walk through it.
Let's say you have a $100,000 trading account. Your algorithm pings and says it's time to buy a specific stock that is currently priced at $30 a share. First, the algorithm looks at the volatility, the ATR. Say the ATR is $2. It moves about $2 a day.
Correct. So the very first step is establishing your emergency exit, your stop loss, based on that volatility. The book uses an example of setting a stop loss at 2 times the ATR. So 2 times the $2 ATR is $4.
So we subtract that $4 from our $30 entry price.
Exactly. Your hard stop loss is set at $26. This means if the trade goes against you, you are risking exactly $4 per share before the computer automatically sells it.
Right. Now, we apply the percent risk rule. The system's rules state we only ever want to risk exactly 2% of our total $100,000 equity on any single trade. 2% of 100 grand is $2,000.
Yep. That's your max risk budget for this trade.
So we are willing to lose a maximum of $2,000 if this trade goes completely sideways and hits our stop loss. If we are risking $4 a share, we divide our total allowed risk of $2,000 by $4. That math tells us we should buy 500 shares.
But here's where the second rule, percent size, acts as a crucial safety net to prevent you from tying up too much capital in one place. Let's look at the total cost of buying those 500 shares. 500 shares at $30 a share is $15,000.
And remember, the system has a hard structural cap. You can never invest more than 10% of your total account equity in a single position. 10% of our 100K account is only $10,000.
Right, so the $15,000 required to buy the 500 shares violates that rule. The ballast tank is too full.
It's too heavy.
Exactly. So the system forces you to size down. You take that maximum $10,000 allowed, divide it by the $30 share price, and you get 333 shares. There's the final clinically calculated position size. You buy exactly 333 shares.
Because it fully respects both the volatility risk limit and the total equity allocation limit.
Yes.
It is so clinical. It's pure, emotionless, undeniable math. And applying this mathematical approach to risk requires a total, absolute detachment from the daily narratives spun by the outside world. You cannot let outside noise affect the algorithm's math.
You really can't.
Which brings us to perhaps my favorite concept in this entire deep dive. Lesson 6, fire the news.
Oh, this is a great one.
Going back to our submarine, this is the realization that you cannot navigate the deep ocean by looking out a glass window into the dark, murky water. You have to trust the sonar.
It is incredibly liberating once you accept it. The source text is very direct about this. The financial media networks like CNBC, Bloomberg, publications like the Wall Street Journal, they have a very specific corporate agenda, and I assure you, it is not to make you a wealthy, calm, independent investor.
Shocking, I know.
Right. Their agenda is to generate advertising revenue and boost subscription metrics. And how do you reliably do that? By keeping human beings hooked on a constant intravenous drip of fear, panic, and breaking news urgency.
They want you staring at a screen full of bright red tickers while an analyst in a nice suit screams that the sky is falling.
Exactly. But the fundamental reality of quantitative algorithmic trading aligns closely with the efficient market hypothesis. By the time a pundit is breathlessly discussing a news event on television, that information has already been priced into the stock by institutional supercomputers.
If you react to the news, you are already too late. You are the sucker at the table.
You are. Quantitative trading strictly relies on historical price action, not predictive fundamentals or whatever macroeconomic narrative is currently trending on Twitter.
Or X, as it's called now. But yeah, this gets back to the neurology we discussed earlier.
Human beings suffer from terrible loss aversion. The psychological pain we feel from losing $1,000 is vastly more intense than the joy we feel from making $1,000.
I mean, absolutely. It's hardwired into us.
If you are sitting there watching your portfolio drop in value while simultaneously absorbing a media narrative of global economic collapse, it is virtually guaranteed that you will make a decision based on sheer terror, not mathematical logic.
You will manually override your system and hit the panic sell button.
Yes. By completely ignoring the news, by literally turning off the TV, you remove the psychological catalyst for that emotional self-sabotage.
But surely, and I can hear a skeptical listener saying this right now, surely knowing that a company just fired its CEO for massive embezzlement, or knowing they just released a terrible earnings report showing millions in unexpected losses, surely that is important fundamental information you need to factor in before buying a stock.
I get that logic. But this raises an important question about what actually matters in the modern market structure. The material argues convincingly that price action is the ultimate truth serum.
The price action tells the whole story.
The market's reaction to the news, the actual printed movement of the stock price, tells you absolutely everything you need to know. If a CEO is fired for fraud and the institutional money panics, the stock price will plummet.
You don't need to read the press release.
No. Your trend-following algorithm's trailing stop loss will automatically trigger at your predefined ATR level and seamlessly take you out of the trade. You are safe.
Conversely, if the stock drops dramatically on bad earnings, but hits the mathematical parameters of your oversold mean reversion system, the algorithm will automatically buy the fear, regardless of why the fear exists in the headlines.
Ignoring the why and focusing purely on the what, the indisputable mathematical price action, strips away all the emotional bias, cognitive dissonance, and analysis paralysis of trying to forecast complex fundamentals.
I love the analogy of a thermometer for this. You don't need to interview the local meteorologist for an hour to know if it's freezing outside. The thermometer just objectively tells you it's 20 degrees. Put on a coat. The price action is the thermometer.
That's a perfect analogy.
And ignoring the scary news is a whole lot easier when you know your portfolio submarine is armored against the absolute worst-case global scenarios. Which leads us to the emergency blow system of our sub. Lesson 7, buy your catastrophe insurance.
This deals with a very specific, very dangerous concept called correlation risk. We discussed how non-correlated systems are the holy grail of this methodology. However, the data reveals a terrifying truth.
What's that?
During a massive systemic global market panic like the 2008 Lehman collapse or the 1987 Black Monday crash, previously non-correlated long systems will suddenly and violently move into lockstep.
Meaning everything just falls together?
Yes. In a true panic, the correlation of all assets goes to 1. Everything drops together. The sector doesn't matter, the fundamentals don't matter, the earnings don't matter. It's a blind race for liquidity. Institutional funds get margin called, and they are forced to sell everything they own, even the good stocks, just to raise cash.
And that's where System 7 in the author's suite of algorithms comes in. It's explicitly designated as the catastrophe hedge.
It is a highly specific long-term trend following short system. Now, here is the massive psychological catch.
Okay, lay it on me.
Because the U.S. stock market has a historical upward bias over time, a system that strictly bets on long, sustained, downward macroeconomic trends is going to lose money most years. It is mathematically designed to bleed a little bit of money to suffer small, manageable paper cuts during a 10-year bull market.
But during an extreme, protracted global sell-off, it makes massive, massive profits.
Exactly. And that introduces an incredibly difficult psychological barrier for many traders, even algorithmic ones. Paying for a system that actively loses money year after year feels deeply counterintuitive. It feels like you coded a broken robot.
Right. I have to push back here. You're telling me to intentionally program a bot that bleeds my account dry for 10 years straight. How is anyone supposed to stomach that psychologically? Why not just hold cash if you're worried about a crash?
Because holding cash doesn't exponentially increase in value precisely when the rest of your assets are plunging.
Yeah.
You have to conceptually reframe what this specific algorithm is doing.
Reframe it how?
It is not an investment in the traditional sense. It is literally an insurance premium. When the floor falls out of the global economy and all your long systems are hitting their stop losses and converting to cash, this catastrophe hedge acts as a massive golden parachute.
Oh, I see.
The profits from this short system fund your overall portfolio and keep your equity curve mathematically smooth while everyone else's wealth is burning to the ground.
Okay, let's unpack this with a real-world analogy. You pay your car insurance premium every single month, right? Hundreds of dollars a month. And at the end of the year, if you drove safely and didn't crash your car, you don't call up your insurance agent and scream, "This system is broken. I lost money on this policy."
No, you're just glad you didn't crash.
Exactly. You're thrilled you didn't crash, but you happily paid for the financial protection just in case a drunk driver hit you. It's the exact same logic here. You shouldn't complain when your short systems create a minor drag on your returns during a historic, decade-long bull run. They are doing exactly what they are programmed to do, patiently waiting in the background for a systemic crash.
Precisely. And deciding whether you can actually stomach paying that insurance premium year after year, watching that specific system lose money, requires deep self-reflection about what you actually want out of trading and what your true emotional limits are.
Which brings us to the psychological core of the entire book. Lesson 8, Objectives over Returns.
This is where human ego meets mathematical reality.
Most amateur traders come into the market chasing a pure fantasy. They want a 100% annual return. They put it in an Excel spreadsheet, calculate how quickly compounding interest will make them a billionaire, and literally start picking out the color of their yacht.
Yeah, we've all seen those guys.
But they are completely blind to the fact that return and risk are eternally linked by mathematics. To get a 100% return in a year, you generally have to risk destroying the entire bank.
You do. The material insists that before you even look at a stock chart, Before you write a single line of code, you must clearly define your objectives, your acceptable maximum drawdown, your average drawdown, and your drawdown duration.
And the author provides a brutal but necessary rule of thumb here.
If you look at the historical data of how traders behave, there's a brutal reality you have to accept. Whatever you claim your maximum acceptable drawdown is, cut it in half.
Cut it in half, wow.
Human beings are incredibly terrible at forecasting their own emotional resilience in the face of actual realized financial loss. They look at a back-tested equity curve on a piece of paper, see a 30% dip in the chart that eventually recovers to new highs a year later, and say, sure, I can handle a 30% drop, no problem, I'm strong.
But living through that 30% drop in real time is a completely different, soul-crushing experience. The text gives a fantastic, terrifyingly relatable example.
What was the example?
Imagine a trader with a $500,000 account. Maybe it's the sum total of their life savings from 30 years of working. They proudly claim they can handle a 30% drawdown to achieve those 30% CAGR returns.
Right.
But imagine the reality. Logging in every day for 12 straight months, watching that account slowly, relentlessly bleed down to $350,000. The visceral waking panic of losing $150,000 of real hard-earned money is agonizing.
It's pure torture.
That psychological pressure, the arguments it causes with their spouse, the fear of ruined retirement, it will almost certainly cause them to abandon the algorithmic system, manually override the rules, and sell everything to cash at the absolute worst possible time.
This raises an important question. Why do systematic, quantitative traders actually fail? It is very rarely because their back-tested algorithms are mathematically flawed.
It's because of them, the traders.
Yes, they fail because the system they built violates their own personal belief structure and emotional limits. If you know deep down in your gut that you cannot sleep at night if your account drops 15%, that you must engineer a system using strict position sizing, smaller ATR multiples, and more non-correlated defensive assets, that mathematically caps drawdowns at 10%.
Even if it limits your upside.
You have to do this even if it means sacrificing yield, capping your potential upside CAGR at 15% instead of a flashy 30%. You have to trade a system you can actually stick with during the dark, painful times.
Because a perfect system you abandon in a panic is vastly inferior to an average system you stick with for 20 years.
So well said.
So once you have done that deep psychological work and you've aligned your financial objectives with your actual honest risk tolerance, how do you actually trust the machine to execute?
Good question.
How do you know the algorithm you just built isn't just a fantasy that looked good on a spreadsheet? That is the focus of Lesson 9, Evidence-Based Confidence.
Confidence in this algorithmic approach does not come from a gut feeling.
Right.
It doesn't come from reading a positive article on a financial blog, and it certainly doesn't come from a Wall Street analyst's promise.
Where does it come from then?
True confidence comes exclusively from rigorously backtesting simple, conceptually sound algorithms across decades of actual historical market data. You test the mathematical rules through the 2000 dot-com bust, the 2008 financial crisis, the 2020 pandemic crash, periods of high inflation in the 70s, and years of sideways chop.
And if it survives all that?
If the system proves it has a statistical edge across a massive sample size of thousands of simulated trades, you have evidence-based confidence.
But there is a massive trap here that the material warns about, and we need to explain it clearly. Beware of data mining, also known as curve fitting. This is the trap of over-optimizing your computer's parameters to fit the past perfectly.
It's such an easy trap to fall into.
For example, you might tweak your moving average algorithm to use exactly a 31.4-day average rather than a standard 50-day average, simply because that highly specific number magically makes the backtest chart from 2008 look flawlessly profitable.
Right, looks like a masterpiece.
But the future will never exactly mirror the past. That 31.4-day average has no basis in market reality. It's just a statistical anomaly you found.
Exactly. Instead of data mining, you have to focus on what the author calls conceptually correct systems. As we discussed earlier with the rubber band analogy, buying an oversold dip makes conceptual psychological sense because market makers have to provide liquidity. You can tweak the exact entry number slightly, and the core concept still holds up robustly.
That is a structurally sound system.
To build these robust systems, the text outlines 12 essential ingredients that must be explicitly defined in your code. We've touched on several, like defining objectives, identifying beliefs, and position sizing. But it also includes deeply technical steps.
Like what?
You must define your precise trading universe. Are you letting the algorithm trade the entire S&P 500, or are you restricting it to the NASDAQ 100? You must build filters for liquidity, ensuring the computer only buys stocks that trade millions of shares a day so you don't get trapped in a penny stock.
Very important.
You need market regime filters to tell the algorithm if the overall market is in a bull or bear phase. You need the exact setup conditions, the specific trigger that executes the trade, the hard stop loss to protect capital, the profit-taking rules, and the portfolio sizing rules.
It is incredibly comprehensive. Every single variable is accounted for before a dollar is ever risked. And when all 12 ingredients are quantified, the backtesting proves your statistical edge.
Yes.
And when you know mathematically that a long-term trend system is supposed to lose some money when a macroeconomic trend finally bends, a 20% drawdown in that specific engine room doesn't cause you to panic and abandon ship. It is just the algorithm doing exactly what it was designed to do. But I have to put myself in the shoes of the listener right now, running this system in the real world. If I am executing the system flawlessly and I hit a brutal 6-month losing streak where my overall portfolio is just flat or bleeding slightly downward week after week, how do I actually know if the system is genuinely broken because the fundamental structure of the market has changed, or if it's just what the author calls temporary non-performance?
That is the ultimate crucible for a quantitative trader. That is the true test of discipline. And the answer relies entirely on the cold, hard data you gathered during your decades of backtesting.
The baseline data.
Because you have quantified your maximum historical drawdowns and your longest historical drawdown durations across decades of data, you have an objective statistical baseline. If your backtest shows that historically, in 2004, this exact system once went 14 months without making a new equity high, then a current 6-month losing streak is well within normal expected operating parameters.
It is simply temporary non-performance. It's winter.
As long as the system is operating within those established historical boundaries, you must ruthlessly, mechanically follow the rules and continue executing the trades.
And if it goes outside the boundaries?
If the drawdown exceeds those historical maximums significantly, say it drops 40% when the backtest said the worst ever was 20%, then, and only then, do you halt trading and fundamentally reevaluate the code.
It requires such an intense, almost inhuman level of emotional detachment. It fundamentally changes what the day-to-day life of a trader actually looks like.
It's nothing like the movies.
Right. I think the popular Hollywood image of a trader is a guy in a tailored vest screaming into 2 phones, staring at a wall of 6 monitors flashing red and green, mainlining espresso, and making million-dollar decisions on gut instinct.
Yeah, buy, buy, sell, sell.
Exactly. But this quantitative approach is the exact polar opposite. Which brings us to our final component, Lesson 10. Trading should be boring.
It really, truly should be boring. The author describes this methodology as a get-rich-slow approach.
I love that. Get rich slow.
Now, to be clear, it requires a heavy, heavy amount of upfront intellectual labor. You have to spend months defining your psychological objectives, rigorously testing the 12 ingredients, backtesting the algorithms, stress testing the code, and setting up the automated brokerage connections.
Building the submarine takes time.
Yes, but once the submarine is built, sealed, and launched, operating it takes 10 to 60 minutes a day, and it is entirely executed outside of active market hours.
Right. You don't sit there watching the blinking lights. At 5:00 p.m. after the market is closed, you download the end-of-day pricing data. Your computer runs the algorithms against that data in a few seconds. It generates a simple, emotionless text list of buy and sell orders for the next day.
That's all it is, a text file.
You log into your broker, route those specific limit orders for the next morning's open, and you walk away. The computer does all the heavy analytical lifting. The trader just functions as the administrator executing the signals.
Many people unconsciously trade for excitement. They trade for the gambling thrills, the dopamine hits of a winning stock, or to feel like they are plugged into the pulse of global geopolitical events.
Like they're playing a video game.
Exactly. This quantitative approach ruthlessly removes all the adrenaline from the process. It treats wealth generation not like a weekend at a Vegas casino, but like a boring, highly efficient, heavily automated factory.
I want to look under the hood of that idea for a second because it's a massive shift in mindset. If you are sweating, if you are shouting at the TV screen, if you are feeling your heart rate spike while you are looking at your portfolio, you aren't investing, you are gambling.
You are at the casino.
Real, sustainable, generational wealth generation is like watching paint dry. But the secret, the absolute luxury of this system is knowing mathematically that the paint is made of liquid gold.
And that leads to the ultimate payoff of this entire philosophy. The ultimate luxury the system provides isn't just financial wealth, although the 30% historical CAGR is incredible.
It's life-changing money, yeah.
But the ultimate luxury is time wealth. Escaping the glowing screens, ignoring the manic 24/7 news cycle, and trusting a mathematically proven system allows you to actually go live your life.
You get your day back.
You can spend time with your family, travel, build a business, completely confident that your wealth is mathematically protected in an armored submarine against whatever storms the macroeconomic world throws at it.
What an incredible journey through this material. We've deconstructed the illusion of skill driven by bull markets, broken out of the benchmark trap of the S&P 500, and built a heavily armored submarine using the 4 pillars of non-correlation.
It's a completely new paradigm.
We learned that position sizing and ATR are our only real levers to manage risk. We fired the financial news and learned to trust our sonar. We bought our catastrophe insurance hedge even though it hurts to pay the premium. And we embraced the absolute luxury of boring, evidence-based 10-minute-a-day trading.
It's a lot to take in, but it's powerful.
But as we wrap up this deep dive, I want to leave you, the listener, with a final provocative thought to mull over as you look at your own portfolio. What if the greatest risk to your wealth isn't a market crash? What if it isn't the Federal Reserve's interest rates, or a global recession, or a sudden black swan news event? What if the single greatest risk to your financial future is actually your own biological hardwiring, your deep-seated neurological need to feel in control by reacting to the noise? If you can surrender the illusion of prediction and yield to the cold, undeniable reality of statistics and automation, you don't just conquer the market, you conquer yourself. Thank you for watching all. Please like, share, subscribe, follow up in next video.